Silver didn't just trade above $68, it broke through it. And what followed is the part most people are missing. Because once that level failed, the silver market stopped behaving the way it normally does. Not in headlines, not in analyst forecasts, but in behavior. 68 wasn't just another number on a chart. It was a level that had been tested, defended, and respected for weeks. Each time silver approached it, selling pressure appeared almost on schedule. Not chaotic selling, controlled selling. That kind of behavior usually means large players are active, managing exposure, hedges, and delivery risk quietly in the background. So, when silver finally pushed through 68 and didn't snap back, that wasn't random volatility. That was a failed defense. And once a defended level fails, markets don't react loudly at first. They react subtly. Buyers stop waiting, sellers hesitate, and institutions start watching behavior more closely than price. That shift is what matters here. Because price can move without changing anything. But when behavior changes, the market itself enters a different phase. And that's exactly what started happening once silver broke 68. To understand why this break mattered so much, you have to understand how markets defend levels in the first place. When a price approaches a level repeatedly and fails, it's rarely accidental. It usually means exposure is being managed there. Positions are adjusted, risk is capped, and expectations are built around the assumption that the level will hold. For weeks, 68 functioned like that kind of line. Every approach was met with resistance. Every push higher was absorbed. That creates a sense of stability. Not because the market is calm, but because participants believe the system is still in control. But when that kind of level fails, the consequences aren't immediate fireworks, they're behavioral. The first thing that changes is patience. Buyers who are waiting for pullbacks stop waiting. They start securing exposure earlier, even at higher prices, because the old reference point no longer feels reliable. At the same time, sellers become more selective. They don't rush to add supply the way they did before. They hesitate, unsure whether today's price reflects equilibrium or transition. This is where markets quietly destabilize, not through panic, but through misalignment. The assumptions that guided behavior just hours earlier stop working. And once that happens, price becomes less informative than behavior itself. Because behavior tells you whether participants still trust the system or whether they started preparing for something different. That's the signal silver sent after 68 failed. This is where the difference between paper markets and physical markets starts to matter. On the surface, silver still looked liquid. Contracts traded, charts updated, nothing appeared broken. But underneath, the physical side began sending different signals. Premiums widened instead of tightening. Large orders were split into smaller allocations. Delivery language shifted from guarantees to estimates. These aren't random inconveniences. They're early indicators of friction. Physical markets don't react to price alone. They react to availability. And when availability becomes uncertain, behavior changes first. Price follows later. This is where paper structures struggle. They're built on flexibility. They assume time, substitution, and smooth settlement. Physical demand doesn't work that way. Factories don't hedge production schedules. Manufacturers don't delay output because a chart looks extended. They secure supply when continuity feels threatened. Once silver moved above 68 and held, that threat became real enough to change procurement behavior. Not publicly, quietly. And quiet shifts are the most dangerous ones for markets because they don't show up immediately in prices or headlines. They show up in who gets access and who suddenly doesn't. That's when price stops being the main signal. And that's when markets start operating under a different set of rules, even if no one announces it out loud. This is the point where institutions start paying attention, not because price is rising, but because assumptions are breaking. Banks and clearing firms don't panic over upside. They can hedge price. They can manage volatility. What they can't manage easily is delivery risk. Once silver moved through 68 and behavior shifted, risk models had to be reevaluated. Not because silver suddenly became expensive, but because the probability of smooth settlement started changing. That's an uncomfortable place for institutions. Contracts are priced on the assumption that metal can be sourced when needed. When that assumption weakens, exposure stops being theoretical. It becomes operational. This is where internal controls quietly tighten. Margins get reassessed. Counterparty exposure is reviewed. Language around settlement becomes more cautious. None of this shows up in public statements. It shows up in how aggressively risk is allowed to be carried. And this is why behavior matters more than headlines, because by the time rules change publicly, the private adjustments have already been made. $68 was the point where those adjustments began. Not loudly, not dramatically, but quietly enough to change how participants approached the market from that moment forward. And once institutions shift from optimizing returns to protecting function, the character of a market changes, whether the price reflects it yet or not. What makes this moment different from previous silver rallies is where the pressure is coming from. In past cycles, silver moved because speculation moved first. Momentum traders piled in. Leverage expanded, and eventually the move exhausted itself when sentiment turned. This time, the pressure isn't coming from speculation. It's coming from necessity. Industrial buyers don't chase charts. They care about continuity. A production line that runs out of silver doesn't slow down. It stops. That's why, once access becomes uncertain, demand stops responding to price the way markets expect. Buyers don't wait for pullbacks. They secure supply when it's available because the cost of interruption is higher than any premium. This is what economists call inelastic demand. And once demand becomes inelastic, price loses its ability to balance the market smoothly. Instead of dampening demand, higher prices confirm urgency. That's the behavioral shift that began after 68 failed. The market didn't suddenly become bullish. It became defensive. Participants started prioritizing certainty over optimization, access over efficiency, delivery over price. And markets built on leverage and paper claims don't adapt cleanly to that kind of shift. They strain first, then they reprice. And that process rarely feels orderly while it's happening. This is where people usually get confused because the price action doesn't match the narrative they expect. They assume that if a market is under stress, price should move violently and immediately. But structural stress rarely announces itself that way. Instead, you see resistance stop working. Pullbacks become shallow. Selling pressure loses urgency. Attempts to push silver lower after 68 failed didn't restore the old behavior. They didn't bring back confidence. They didn't reset positioning. That's a critical signal. Normal volatility cleans itself up quickly. It scares participants out and restores balance. What we're seeing instead is persistence. The market absorbs pressure without snapping back into its previous range. That tells you the issue isn't emotion, it's structure. Once access risk enters the equation, markets stop negotiating value and start negotiating priority. Who gets filled first? Who waits? Who pays up to avoid uncertainty? This is why focusing on charts alone misses the point. Charts tell you where price has been. Behavior tells you where the market is heading. After 68 broke, behavior didn't normalize. It adapted. And adaptation is far more important than volatility when you are trying to understand whether a move is temporary or the beginning of a different phase entirely. So this is where we are now. Silver breaking 68 wasn't the story. It was the signal. The real change happened underneath, in how participants started behaving once that level no longer held. Buyers moved earlier. Sellers hesitated. Institutions shifted from optimizing exposure to protecting function. That doesn't show up immediately in headlines or price targets. It shows up in priorities. When markets begin prioritizing certainty over price, they don't flip back easily. They don't return to old assumptions just because volatility cools for a day or two. That's what makes this moment different. Now, this isn't about calling a top. It isn't about forecasting where silver goes next week or next month. It's about recognizing that market behavior changed, quietly, structurally, and without announcement. Once behavior changes, price eventually follows. Not because of hype, not because of belief, but because the system is responding to constraints instead of sentiment. Silver didn't become something new overnight. It revealed what it already was once 68 failed. And markets don't forget moments like that. They adjust to them.